Good morning, everyone. My name is Fiso Wuhlimbuto, and today I'll be taking you through some of the highlights from our Philip Morris company update report. So on the summary side of things, we'll be touching on the smoke-free products, the brand equity, and decreasing cigarette exposure within Philip Morris itself, which at this stage makes it a defensive counter. What we did also take into consideration is just valuation levels overall, specifically from a PE perspective. They seem quite elevated, and considering the growth and the elevated PEs, we end up at an intrinsic value of about $172 per share with a downside of 1% and a hold recommendation. My recommendation is based on growing volumes and rising revenue share of the smoke-free products to offset some of the risk associated with the downtrending cigarette volumes amidst changing nicotine consumption methods and a more health-conscious consumer. The second point is just re-entry into the US market through Swedish Match, but is primarily focusing on smoke-free products. The exposure in the US is currently moderate at about 6% of revenue, but what is important to take into context here is this. Philip Morris and Altria used to be a single company, and then for regulatory reasons they had to separate, and Altria primarily focused on operating in the US, whereas Philip Morris primarily focused on operating in anywhere but the US. The other bit is just stable top-line growth expectations with high single-digit adjusted earnings per share growth in FY26, including an expected 3% decline in cigarette volumes. Now, although the guidance is healthy, with the stock being an avid dividend payer and a defensive staple, valuations from a PE perspective remain elevated, and this has led us to a hold recommendation.